Hi, everybody. Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania. And I am excited for the first of the month update. It is September, and you can see by my shirt and my team, obviously I'm a Minnesota Golden Gopher, and college football season's underway along with high school and the pros. So thank goodness we have something to watch on TV now. So hey, we're going to delve into the first of the month update, and I start with a cartoon. Now, if you've been watching my videos religiously, which I hope you have, I was mentioning back in July that it would not be unusual for the markets to have a 5 to 7% pullback with the major indices. So this doesn't qualify as a bear market. Typically, bear markets qualify as a 20% pullback. This has only been about a 5 to 7%. And here's my chart of the S&P 500, and you can see where I have the down arrow. That was the end of July, where the S&P closed at 45.88. And almost to the exact percent, we came down to 43.59, which was a 5% retracement. Now, the NASDAQ had a little bit a bigger retracement, almost 7% in the month of August, but we'll see again where we finish up at the end of August. Now, what does this mean for September? September is another traditionally bad month for the stock market. A lot of people think it's October, but if you look at it from a statistical standpoint, the two weakest months out of the year happen to be August and September. So the question is, are we going to fall back and have a little bit more of a pullback in September? That is possible, but I would probably venture to guess that we're probably going to grind sideways for the month of September until we get to October, where third quarter earnings are going to be released. Now, one of the reasons why the stock market pulled back was that we had the infamous or famous Jackson Hole comment last week. We had Jerome Powell come out of Jackson Hole, and he said if they need to, they will keep raising short-term interest rates to combat inflation. Well, this is my chart of the 10-year Treasury, and if you look at this, we are at almost the exact same spot as we were in October of 2022, when the 10-year Treasury peaked right around 4.3%. So this time what I think is different is I think the 10-year Treasury is offering a lot of value, or any what they call longer duration bonds. So if you're in a high income tax bracket, you should be looking at longer duration municipal bonds. The taxable equivalent yield on some of these bonds is literally over 7%. So what does that mean? It means if you get 4% on a tax-free bond, that you would have to get over 7% on a taxable bond in order to equal the haircut you get by obviously paying taxes on a taxable bond. So take a hard look at longer duration tax-free bonds, paying somewhere right around the 4% level. We think there's a lot of value there right now. Obviously, we've been talking about CDs on the short end of the scale. We still think that those offer value. But again, when you hear me talk about lengthening duration, that's just a fancy word for buying some longer term bonds in your portfolio at very attractive yields right now. Let me talk to you about something else that's been going on, the growth stock versus value stock debate. And this has been running rampant. And this particular chart is a chart of the VUG, the Vanguard Growth Index, and the VTV, the Vanguard Value Index. Now, there are very popular exchange-traded funds that you can actually invest in. And you can see whenever there's a green line, that means the growth index, or the Vanguard Growth Index, VUG, has been outperforming the Vanguard Value Index. Now, look where we were on the left-hand side. This goes back to 1997, 1998, as far as this chart goes. And you can see that there was a period of time, and actually it peaked where there was a large outperformance by growth versus value. Over on the right-hand side of the chart, you can see at the end of 2019, 2020, during the pandemic, you saw a lot of the stay-at-home stocks, which were growth-oriented stocks. And again, this is not a recommendation to buy these individual names, but stocks like Microsoft really soared. Then if you look here where it was red in 2022, obviously the market was down last year. The S&P 500 was down around 17%. The NASDAQ was down around 30%. Those growth stocks were incredibly out of favor. And if you'd rotated into growth at the time, you would have picked up a lot of performance. Now, flash forward where we are on the right-hand side, and you can see once again, growth is way out of, is doing much better than value. So if you believe in a regression to the mean, like I do, that value could end up being a better performing place to be with your portfolio going into 2024. Now, we have a lot of clients and we that are dividend oriented. And obviously the dividend stocks, the yield stocks have not done as well this year. And the reason being is growth has greatly outperformed value. So the point that I'm trying to make here with this chart is that those that are patient and are staying invested in their dividend stocks should be rewarded going into 2024, because again, there's something called regression to the mean, where obviously if one asset class way outperforms, sooner or later people identify that that asset class is very expensive. The other asset class, in this case, value, i.e. dividend stocks, is extremely cheap. So again, this is the growth versus value debate. We think that there's some opportunities there. And just to sum it all up, you can see indices pulled back in August. We think that they may end up trading more sideways in September as we look forward to third quarter earnings. Yield on the 10-year Treasury peaked right around 425, 430. We think that offers some opportunity in longer duration bonds. So this weekend when you're at the beach or you're at a cookout and somebody asks you, hey, what do you think about those investment markets? You can use that fancy term, longer duration bonds. All that means is buying longer bonds when interest rates are high. And again, to sum it up, we think value stocks are very undervalued, no pun intended, and that growth stocks obviously could be challenged. And if you believe in a regression to the mean trade like we do, that there's some opportunities to be had there. That's all we have now for September. We'll be back first part of October. Everybody have a great time. We'll talk to you soon.